Because what's happening right now isn't a gentle cool down. It's not a soft landing. It's pressure building under the surface, like a fault line that's been silent for years, right before the earthquake. For a decade, California real estate sold a single story: buy anything, anywhere, and time will save you. And in 2020 to 2022, people believed it. They bid over ask. They waived inspections. They called it equity. But now, that equity is evaporating, quietly in some cities, violently in others. And here's the part nobody wants to admit. This isn't just about prices. This is about families trapped underwater, sellers bleeding out through price cuts, and buyers frozen because the monthly payment feels like a punishment. It's about insurance premiums climbing like a fever, while entire neighborhoods turn into stale listings that sit and sit and sit. California's not hot, it's hemorrhaging. Today, we're counting down the top 10 California cities where home prices are falling like a rock. The places where the market looks strong from far away, but up close, you can smell the smoke. And why does this matter right now? Because the window between "I can still get out" and "I'm stuck here for years" closes fast. Inventory rises. Buyers demand concessions. Sellers panic. And when that psychology flips, the fall accelerates. If you want data-driven, no BS housing market breakdowns, the cities, the numbers, and the real human impact, subscribe. This channel tracks the markets before they hit the headlines. All right, deep breath. Let's dive in. Number 10, Fresno. Fresno used to feel like California's affordable escape hatch, a place where Bay Area money could land and still breathe. Not anymore. Now it feels like the air is getting thin, like the market is suffocating under its own weight. Here's what the numbers say. No vibes, no coping. Median sale price, $379,000 source. Year-over-year change, down 0.66% source days on market. 58 days, up from 32 last year's source. Median price per SQFT, 253, up 2.8% source homes sold. Dec, 292, up from 262 source. But it's not just price. The reason? The payment math. Higher rates turn affordable into financial quicksand. What's making it worse? Fresno's demand relies on people fleeing more expensive metros, and that pipeline slows when everyone else freezes. And then there's the reality that buyers now wait out sellers. They don't chase. They watch you bleed. This hits hardest for first-time buyers who stretched in 2022 and expected instant appreciation. Now they stare at comps sliding while groceries, insurance, and utilities climb. Teachers, hospital staff, service workers, people who can't just hold forever. You're not alone. Investors who treated Fresno like a rental machine? They start quiet dumping. Sellers offer credits, rate buydowns, anything to stop the listing from turning into a ghost town. Fresno doesn't crash with fireworks. It crashes with silence. Slow, stubborn, and then all at once, gone, over, done. Number 9, Riverside. Riverside once ran on a simple promise: commute farther, buy bigger, build wealth. Now that promise feels like a trap snapping shut. The Inland Empire turns into ground zero for stretched budgets. Median sale price, $640,000 source. Yo, why change? Down 0.47% source. Days on market, 52 days, source sale to list. All homes. 98.5%. Sellers losing leverage source. Typical deal. Homes sell about 1% below list, with hot homes going pending in our 16 days source. But it's not just Riverside. The reason? The Inland Empire ran on low rates. When rates rise, the whole system starts drowning. What's making it worse? Long commutes, plus gas, plus childcare, plus insurance, monthly payment meltdown. And then there's buyer fatigue. They stop bidding. They start negotiating like sharks. Families who bought at the peak now carry the cost. The mortgage hits first, then HOA, then insurance, then repairs. Then the realization: if I sell, I bring money to the closing table. That's the definition of underwater. Sellers toss incentives like life rafts, closing credits, rate buy-downs, price to sell. Investors pull back, lenders tighten. The market becomes a slow war of attrition. Riverside doesn't just cool, it becomes the kind of place where listings sit until sellers crack. And it gets worse. Number 8. Santa Rosa. Santa Rosa sells wine country dreams, rolling hills, calm mornings, weekend escapes. But the housing market? It's turning into a slow-motion storm surge. Median sale price, $704.95 source. YOY change, down 2.4% source. Days on market, 65 days. Up from 48 source price per SQFT, 434. Down 3.6% source. Homes sold, DEC, 124. Up from 96 source. But it's not just affordability. The reason? Insurance and risk. California's home insurance world is breaking. Insurers pull back, premiums rise, and vulnerable homeowners feel it first. The Turner Center documents rising premiums and reduced options as wildfire risk grows source. And then there's the psychology. Second home buyers vanish when fear shows up. Retirees who plan to cash out. They watch offers come in low. Families who bought in places like Fountain Grove or near Oakmont now juggle higher ownership costs, while buyers demand discounts. Sellers chase the market downward. Price cuts stack, listings linger. Investors who banked on short-term rentals start rethinking the entire plan. Santa Rosa promised serenity. Now it delivers uncertainty, where home values bleed while costs climb. Stay until number 1. If you're finding this eye-opening, subscribe, because the headlines always arrive late. And tell me in the comments, which California city are you watching right now? What are you seeing? Price cuts? Incentives? Listings sitting? Number 7. Palm Springs. Palm Springs used to be a desert fantasy. Weekend. Homes, pool parties, Airbnb cash flow. Now that fantasy is evaporating in the heat, the market turns from glam to ghost town. Median sale price, $650,000 source. YOY change, down 4.8% source. Days on market, 69 days, basically stuck. Source median, just QFT, $442, up 1.4%. Source sale, to list, 96.6%. That's seller pain in one number source. But it's not just prices. The reason? Second home demand collapses first when the economy feels shaky. What's making it worse? STR regulations tighten, booking revenue softens, and suddenly that investment property becomes a drowning expense. And then there's heat, insurance, maintenance. Pools don't pay for themselves. People who bought at the peak thinking, I'll rent it out now, cover a mortgage that doesn't get covered back. Retirees who stretched for the dream, they stare at a monthly burn rate that feels like hemorrhaging. Investors don't negotiate with emotions, they panic sell. Sellers offer credits. Listings stack up. In pockets like the movie colony, Taquit's River Estates, Deepwell Estates, and buyers move like snipers, not tourists. Palm Springs promised easy money. Now it delivers the opposite. Long holds, lower offers, and a market that looks calm, right before another drop. Number 6. Stockton. Stockton once rode the wave of Bay Area overflow. Now it feels like the wave recedes and leaves debris everywhere. The market turns into casualties of a boom built on distance and desperation. Median sale price, $439,000 source. YOY change, down 4.7% source. Days on market, 48 days, up from 38 source. Median or SQFT, 264, down 2.6% source. Sale to list, 98.5%. Buyers hold the blade source. But it's not just one metric. The reason? This market depends on commuters, remote workers, and affordability seekers. What's making it worse? Remote work certainty fades, and those I'll just drive lifestyles hit a wall. And then there's out-migration pressure statewide. California keeps ranking last on net U-Haul migration for the 6th straight year source. This is where the pain looks real. Families who bought with thin down payments now sit underwater fast. Nurses, warehouse workers, teachers, people who can't absorb big shocks, watch their starter home turn into a financial anchor. Sellers cut first, then they cut again. Investors exit quietly. Lenders demand cleaner files. Buyers come in low and refuse to move. Stockton already lived through housing trauma once. Now the market starts to rhyme again, and it gets worse. We're not even in the top 5 yet. Subscribe if you want the next cities before everyone else talks about them. And if you live in Stockton, or anywhere on this list, tell us what you're seeing. Are listings sitting? Are price cuts everywhere? Number 5. Sacramento. Sacramento wore a crown during the remote work boom. It became the new Bay Area. But now the crown slips. The shine fades. And the market shows cracks like a sidewalk after a drought. Median sale price, $472,000, DEC 2025. Source, YoY change, down 2.7%. Source, days on market. Sacramento homes sell in just 19 days. Hot pockets still exist. Source, compete score, very competitive, 83-100. Source, sale to list, 99.8%. Momentum weakening, source. But it's not just the median. The reason? Sacramento became the pressure valve for Bay Area escapees. If that flow slows, demand falls off a cliff. What's making it worse? California's broader migration picture keeps flashing warning lights. U-Haul data shows California continues to lead the nation in net out-migration source. And then there's affordability. The payment hits like artillery. Families who bought in Natimus, Elk Grove, and around Midtown adjacent areas during bidding wars now face a market that doesn't reward them for overpaying. They don't feel rich. They feel trapped. Sellers who test the market get punished. Buyers ignore overpriced listings. Builders push incentives. Investors stop catching falling knives. Sacramento doesn't announce a crash. It lets it creep. And one day you look up and realize the wealth story is gone. Number 4. San Diego. San Diego sells perfection, ocean air, palm trees lifestyle. But even paradise bleeds. And right now, the housing market looks less like a beach day and more like a rip current dragging sellers under. Median sale price, $90,000. Source, YoY change, down 1.8%. Source homes sell after 37 days. Source homes sold, DEC 768, up from 752. Source. Neighborhood softness shows up in places like downtown and southern San Diego, where declines appear in submarket. Source. But it's not just price. The reason? The payment-to-income ratio turns brutal at this level. What's making it worse? Insurance instability statewide. Premium increases and insurer pullbacks squeeze homeowners, especially in risk-prone zone. Source. And then there's migration churn. People still love San Diego, but they don't love the bill. This punishes regular buyers the most. A family that finally stretched into a $930K market now pays like they bought a luxury asset. Nurses, firefighters, teachers, people who keep the city alive, get priced into financial suffocation. Sellers stop dictating terms. Buyers demand repairs, credits, concessions. Investors get picky. Lenders get strict. The vibe flips from offer deadline to please, just bring an offer. San Diego promised safety. Now it delivers a warning. When affordability breaks, even the beach can't save your Zestimate. Number 3. Los Angeles. Los Angeles never imagines itself vulnerable. This city sells confidence, fame, eternity. But the housing market right now? It looks like a giant machine that started leaking oil, and nobody wants to admit the engine is failing. Median sale price, $1,500. Source. YoY change, down 2.2%. Source days on market, 62 days, up from 53. Source. Sale to list, 99.0%. Slipping. Source, market behavior, homes typically sell 1% below list, and hot homes still move fast. Source. But it's not just the median. The reason? LA runs on high income and high volatility. What's making it worse? People keep leaving California for affordability. U-Haul data shows the state remains last for net migration. Source. And then there's the insurance squeeze and disaster risk pressure statewide. Source. In real neighborhoods, Silver Lake, Sherman Oaks, Woodland Hills. Families stare at listings sitting longer. Sellers who bought in 2022 now face the nightmare. Selling means admitting the dream was overpriced. Sellers get desperate. Incentives show up. Price cuts become routine. Investors stop calling LA safe and start calling it risk. LA promised forever. But markets don't care about myths. When affordability breaks, the city bleeds like any other. If you want the top two, because number 2 and number 1 get ugly, hit subscribe right now. And comment. Do you think California has a crash in 2026 or a slow-motion collapse? Number 2, San Jose. San Jose is supposed to be bulletproof. The beating heart of Silicon Valley. The land of stock options and endless demand. But the market right now? It looks like a high-wire act in heavy wind. And one wrong step turns into a free fall. Median sale price, $1,410,000 source. YOY change, plus 3.7%. Yes, up. Stay with me. Source days on market, 21 days versus 18 last year. Source sale to list, 101.8%, down 1.2 points. YOY, momentum fading. Source net outflow destination pressure. Sacramento ranks as a top destination for people leaving source. But it's not just today's price. The reason? The fragility underneath. San Jose's housing survives on tech confidence. What's making it worse? Layoffs and job cut fear keep showing up in headlines. And when high-income buyers hesitate, the top of the market goes first. And then there's the statewide exodus narrative. Regular people keep leaving California for cost reasons source. Here's the brutal part. Even if prices don't plunge overnight, families paying Silicon Valley numbers feel trapped. A small shift wipes out huge chunks of equity because the base is so high. One correction and buyers drown instantly. Investors pull back first. Sellers who need to move compete harder. Buyers demand repairs and credits even in good areas like Willow Glen, Almaden Valley, and Berryessa. San Jose sells certainty. But certainty dies fast when the job engine sputters. And if this market flips, it doesn't fall gently. It falls like a rock. Number 1, Stockton. You thought the worst would be the coast. Think Los Angeles. Think San Diego. Think the Bay. Think again. The real crash epicenter always shows up where people stretch the most, where affordability looked safe until it didn't. That's why Stockton takes the number 1 spot as the symbol of the trap market effect, the place where distance, debt, and desperation collide. Median sale price, $439,000. Source, YOY drop, 4.7%. Source days on market, 48 days, rising. Source, median, SQFT, 264, down 2.6%. Source, sale to list, 98.5%. Buyers dictate terms, source. But it's not just Stockton, it's the pattern Stockton represents. The reason, when rates rise, buyers retreat. When buyers retreat, sellers cut. When sellers cut, comps reset. And then equity bleeds out. What's making it worse? California's net out migration keeps hammering demand. U-Haul shows the state remains last again source. And then there's the psychological flip. People stop believing it always goes up. This is where you see the casualties. Families who bought at the peak with minimal down payments, expecting appreciation to rescue them. Now they face a nightmare. Sell and bring cash, or stay and drown. That's not a spreadsheet problem. That's a life problem. Investors exit, sellers slash, buyers circle, lenders tighten. This becomes a war zone, and homeowners become collateral damage. Stockton is the warning flare, the place where California dream turns into California debt. And it's only beginning. Look at what these cities share, because the pattern screams louder than any single number. First, days on market stretch out. Fresno jumps from 32 to 58 days source. Santa Rosa rises to 65 days source. LA sits at 62 days source. That's not normal seasonality. That's demand weakening in real time. Second, prices don't just flatten. They start bleeding in the places where buyers stretch the hardest. Stockton drops 4.7% YOY source. Palm Springs drops 4.8% YOY source. Los Angeles drops 2.2%, YoY source. The headlines will call it mixed, but the people living it call it panic. Third, the pressure outside housing keeps rising. California's net outmigration keeps flashing red. U-Haul's 2025 data shows California ranks last, again source. And when demand leaks out of a state, housing can't stay invincible forever. And the real threat? Insurance. This isn't a side note. This is gasoline. Insurers pull back, premiums climb, and homeowners lose options, especially in higher risk zones. The Turner Center lays out the escalation clearly. Rising premiums, fewer insurer options, more reliance on backstops like the FAIR Plan, and further rate hikes baked in source. That turns owning into a monthly hemorrhage. This isn't just about real estate. It's about a bigger theme, the end of the free money era. California housing ran on cheap debt, endless optimism, and the belief that risk didn't apply here. That belief is dying. And when belief dies, markets collapse. So here's your move. Don't guess. Track your local numbers. Watch days on market. Watch sale-to-list ratios. Watch price cuts. Because the crash doesn't announce itself with sirens. It shows up as silence, as stale listings, as sellers negotiating against themselves. If you want weekly breakdowns of the cities before they hit mainstream news, subscribe. Drop a comment with your city and what you're seeing on the ground. I read them all. Stay sharp, stay skeptical. See you in the next one.